Good afternoon, everyone. Wherever you are in the world, I hope you and your loved ones are healthy and safe. Thank you for joining the Atlantic Council Global Energy Center for this discussion on the market and geopolitical implications of the OPEC Plus deal and recent G20 negotiations. My name is Randy Bell, and I am the director of the Global Energy Center at the Atlantic Council. We're delighted to host today's expert panel, and I'm honored to be moderating them. First, I'd like to introduce the panelists, all dear friends of the Atlantic Council, and we'll have moderated conversation after that. So to discuss these events, we have with us today Anders Osland, a senior fellow at the Eurasia Center at the Atlantic Council, Halima Croft, managing director and global head of commodity strategy at RBC Capital Markets and a board director of the Atlantic Council, David Goldwyn, chair of the Atlantic Council's Energy Advisory Group and president of Goldwyn Global Strategies. David's also a senior fellow at the Council's Adrian Arch Latin America Center. Kirsten Fontenrose, director of the Scowcroft Middle East Security Initiative at the Atlantic Council. And Robert Johnson, managing director of Energy, Climate, and Natural Resources and executive advisor at the Eurasia Group, and also a senior fellow at the Atlantic Council Global Energy Center. So a really great group of experts with us today to discuss these issues. I can't think of a better lineup to discuss these incredibly busy and unprecedented past few days for oil markets. And for those of you who have not seen this yet today, after watching oil prices slip, President Trump tweeted this morning that OPEC Plus is really looking to cut 20 million barrels per day, not the 9.7 million barrels announced yesterday. So we'll get to what that might mean during these conversations. If you have any questions for the panelists while we're speaking, please use the Q&A function on your Zoom app. Unfortunately, we cannot take questions through any of the other platforms we're streaming on. We'll start taking these questions right away, and I'll try to get to as many questions as I can over the course of the next hour. And finally, you can follow us on Twitter at AC Global Energy and with the hashtag ACEnergy. So let's turn to the conversation. First, Halima, I want to dig into the details of the deal, but first, what does President Trump's tweet to you?
I mean, I think it's basically President Trump taking the win on this agreement. I mean, we did a call, Randy, right after the price war commenced in March, and many of us believed, given how the Saudis were digging in, how it looked like the Russians were digging in, that we would get no off-ramp in this price war until the June OPEC meeting. President Trump's interventions, I think, really changed the trajectory of this crisis. And so I think he wants to basically take the win for getting this deal across the finish line and really trying to get the biggest headline number possible for this cut. He was the one who came out and announced after phone calls with President Putin and King Salman there'd be a 10 to 15 million barrel a day cut. The market was pretty sanguine when there was an announcement Thursday that OPEC Plus had agreed to do 10 million. And so after we got the announcement yesterday of 9.7, I think President Trump is trying to push the biggest headline number possible to get the biggest price response possible. That doesn't mean that we're going to have necessarily 20 million. I think the OPEC agreement, there's some parts of that are incredibly substantial. I think most importantly, the decision of Saudi Arabia and Russia to essentially turn off the tap is incredibly important. When you have a demand crisis, the last thing you need is to be overflowing the bathtub with extra supplies. So it's very important to turn off the tap. The cut from Saudi Arabia will be incredibly meaningful, going down to about 8.5 million barrels a day. The cuts from UAE, Kuwait, also very meaningful. And I think from the perspective of Saudi Arabia, what was really important was getting the Russians to sign up, in principle, to do a cut of around 2.5 million barrels a day. If you go back to what happened on March 6th, the OPEC meeting ended in disaster because the Russians refused to cut an additional 300,000. So to have the Russians out there saying that they're going to do 2.5 million barrels a day, and this is an agreement that will be progressively tapering down, but will be in effect till April 2022, I think it's a major agreement. Again, the devil's going to be in the details in terms of compliance, but I think from the perspective of Saudi Arabia, I think they may believe that they've essentially shown that they're not afraid to go back to market share. They're not afraid to deal with the price implications of market share, and they want to show everyone that that you better show up and make your contributions to OPEC, and they're not going to tolerate free riders. Now, of course, Mexico did get a little bit of a carve out. And what's interesting is that the amount of barrels that was in contention with the Mexicans over the weekend, 300,000, is the same number of barrels that in the case of the Russians caused the agreement to fall apart a month ago. I do think this is where President Trump's interventions again, calling all the relevant heads of state, got the deal across the finish line. So I think it is an incredibly important agreement. It won't solve the problems in the oil market, but it's certainly a necessary first step to being in a better place in the market, potentially in the back half of the year, when we start to get things like US gasoline demand returning, when we start to see people potentially getting on more planes and the recovery of jet fuel demand. There was no way we could kickstart this recovery process without getting this type of OPEC agreement.
On the 300,000 barrels, do you think that that number means something completely different now than it meant at the beginning of March, just as we've come to understand the scale of the demand destruction?
Oh, I think absolutely. I mean, I think when they made that decision in March to essentially say we're going to commence a price war, I think the Saudis always saw the situation clearly. I think His Royal Highness, you have to remember, he wanted a production cut from the beginning of February. It was countries like Russia that essentially said, we don't know the demand impact of the coronavirus. Other countries had that view as well. They said to be panicking to take early action. So I do think that, a month into the price war, when the demand picture became really clear, when all the concerns started to develop about storage filling up, that necessitated taking a cut of this order of magnitude. Again, it's not going to cause an immediate rebound, but it is a necessary, if not sufficient, condition for the rebound to begin.
Got it. Thank you. I want to turn to Anders to talk about Russia for a second. And really, how did Russia get from where it was at the beginning of March, walking out on about 300,000 barrels, to being a major participant just yesterday? So Anders, what's changed in Moscow to get them to be part of the deal?
The decision maker has changed. That's the big difference. So the price war was started by essentially one person, Rosneft's CEO, Igor Sechin, who's one of the people closest to Putin. And he just overruled everybody else. It was only Sechin among the oil executives who wanted to have this price war. And he won over Putin with arguments like, we are an energy superpower. Our economy is stronger than the Saudi economy. We have larger reserves. And with regard to the US, that the US shale producers would go to the wall and go bankrupt soon. But it took only until the 3rd of April when Putin had a public meeting where he took the Minister of Energy, Alexander Novak, who has previously been the negotiator within OPEC, and he made clear that he wanted to have an agreement as soon as possible. And that did then work out gradually. And it's not clear to me if it was Trump or Putin who started the conversation on the 3rd of April, which is worth digging deeper into. My feeling is that it was, or perception is that it was Putin who started it and got on the phone with Trump. And then Putin has got 3 phone calls with President Trump within a week, which is a big thing for Putin. It shows that he's part of the gang again. And the Russian media has come out in quite an uncommon fashion and said that it was only Sechin who pursued this bizarre attitude. And even the number 2 in Lukoil, the second biggest oil company and the biggest private oil company in Russia, producing 1.8 million barrels a day, Fedun came out and praised Putin for his wise decision, and Novak very conspicuously not mentioning Sechin. So the questions here are, is the Russian economy really that weak that Putin got so afraid? I had expected him to do like this in a few months, not now, because it was obvious that the Russian economy couldn't take it, but is the Russian economy that weak? And it's also a question of Sechin. Putin normally doesn't let his top people down so spectacularly as this time. So it poses questions about the strength of Putin's regime and about the Russian economy.
Anders, thanks. We have a question coming in from our friend Dan Fried, who, for those of you who are interested, has just joined Twitter at like Ambassador Dan Fried, Dan Fried. But we're waiting for a tweet from you, Dan. But the question is, following up on Sechin, will this do long-term damage to his reputation and his ability to get things done in Moscow?
Difficult to say. Sechin has done a lot of damage to Russia before. He has cost Russia arguably a couple of hundreds of billions of dollars, and it hasn't cost him anything in his support from Putin previously. Putin has taken him down from time to time. It's difficult to say if this time is different or not. It might be because the Russian economy and the Russian politics are that shaky right now.
Got it. I've got another good question on Russia that I think will be good to Anders, but then potentially others if you want to jump in as well. So from David, how do you feel, what do you think the risk is of Russia reneging on the deal in the short term, the next year? Anders, and then if anyone else wants to jump in, you're welcome to.
It depends on where the oil price lands. If oil price becomes low enough, then the Russian private oil companies will cut their production. So, for example, Lukoil said that they would have cut their production by half if there had not been an agreement now. And they also pointed out that our production cannot start again as easily because our wells will be flooded with water, and that means that we will have to drill new wells instead. While the price is not a major consideration, the Russian costs are about $10 to $15 per barrel. So after the Gulf states, Russia is actually in quite a good position with regard to the price.
Got it. Thank you. Anybody else interested in jumping in on that? Halima, are you willing to answer?
Yeah, I think one of the things I think that Saudi can feel like they achieved from this is there's been a lot of discussion going into the March 6th OPEC meeting that Saudi absolutely needed $70 to $80, that they were essentially committed to cutting now at all costs because of Vision 2030, because of Aramco IPO. I do think that there may be some new disciplining mechanism, not just with Russia, but with a whole host of producers who are compliance challenged. That Saudi Arabia has shown they're not afraid, at least for a pronounced short period, to let prices go. I think that caught people off guard that the Saudis would do that. And I think that is one way of potentially ensuring better compliance going forward.
Got it. Thank you, Halima. David, you wanted to jump in.
Yes, I just agree. I think it's very unlikely that the Russians are going to renege on this deal because Saudi Arabia has demonstrated that they can really hurt the Russians if they want to. What happened after this deal, they not only brought the price down, but through the discounts they offered, they really did successfully eat into Russia's market share in Europe. They were willing to take that Pyrrhic victory and the financial hit, but it did hurt the Russians. And I think that may be part of the story. So I don't think that Putin will let Sechin call that bluff again.
David, do you think Saudi Arabia is the real winner here?
I think they are. I think they went into this deal saying, we need to hang together. We're all going to hang separately. They made a threat that they lived up to take an enormous financial hit in order to bring the price down. And they got the Russians back to the table after they walked away from a $300,000 cut. And now they're at, 2.5 or whatever. So I think they were successful. They were successful in getting the Americans to talk, even though we didn't actually do anything, other than recognize the market. But still, they got the deal back. So I think they showed their relevance. They showed their power. And I think this is Saudi Arabia 1, Russia 0 as far as I scored.
Anders, you wanted to jump in.
Yeah, no, basically I agree that it's of course Russia that has been defeated, but within Russia, it's Igor Sechin who has been defeated. I don't think that Putin minds this. for Putin, it's a big thing that he has got all of his central position on the global stage. And I would argue that it's the same for President Donald Trump. Both wanted to be there.
Got it. Thank you. I want to pivot now to Kirsten. We talked, David mentioned that Saudi's real motivation was trying to get Russia back to the table, but that wasn't necessarily how it was interpreted in the US, at least in different sectors. They thought that the Saudis might be actually aiming for US shale, not just Russia. How did the Saudis' increase in production play in the US, on the Hill, in the administration, in the oil and gas sector? And how did the Saudis react to some of the policy options that were floated that included sort of almost contradictory ideas like a US-Saudi oil alliance on the one hand, or tariffs on Saudi oil, or even one idea went as far as to suggest that the US would remove troops from the kingdom?
Yeah, I think the threats from Congress this week, particularly, especially the one to withdraw troops, were real, and Saudi understood this. Prior to the price war, Republicans in the Senate prevented the passage of legislation intended to punish Saudi, drafted by Democrats concerned about the humanitarian crisis in Yemen and other things. If Republicans and Democrats agree on the need to teach Saudi a lesson, as it looked like would happen, then that legislation would fly through Congress. What would happen then would be whether or not the president would sign a bill into truly being an issue for the Saudis. And the Saudis often believe the president would be unlikely to sign, since he would have problems with part of his base if he signed legislation that effectively resulted in a rise in oil prices, since Saudi would undoubtedly then try to kill US shale in retaliation. But if the virus is still going on, then at the time the president was to sign something like that, then the president would have more leeway, because energy prices wouldn't be a critical issue for the base, while nobody, as Halim mentioned, are driving and factories aren't operating.
Mm-hmm. So what role do you think President Trump and his consistent backing of Saudi actually played in getting Saudi to ultimately acquiesce to Mexico's demands? And we'll get to the Mexican question in a little bit. But what role do you think that strong relationship played in resolving the problem yesterday?
It was twofold. Saudi was a tough partner this week. Even during the G20 meetings, our assistant secretary was running out of meetings to continue these calls. And the president did the shuttle diplomacy between Saudi and Mexico himself. So to Halima's point, that really was kind of the forcing function. All of our diplomats and all of our secretaries were incredibly engaged, but President Trump really did. I mean, when he claims the win, he's kind of not lying in this situation. He told the Saudis that they'd spent enough time wooing Mexico, that Mexico did not need OPEC, and so to move on. And we did lose a little bit of goodwill with the Saudis in this, but it will be rebuilt. I mean, this conversation is what actually delayed that OPEC start by an hour of that meeting, and the U.S. got their deal. So the administration thinks this shows us that there are some cracks in OPEC, which of course create leverage for the U.S. And since we did expend some goodwill, we will have to focus on rebuilding that. I'll stop there. Go ahead.
Got it. No, that's great. Thank you. Thank you very much. So you mentioned Mexico and the role that the U.S. played in that. I want to turn to David. Why did the Mexicans not want to play ball? Why were they balking at the cuts that everyone else seemed to be recognizing as necessary?
Well, I think there were a number of reasons, some economic, some political, and some diplomatic. I think the economic reasons are that Mexico is in deep trouble. I mean, Pemex has got over 100 billion in debt. It's losing about 4 billion this year. They are building things like refineries that they don't need. So the company's in deep trouble. Mexico had hedged, I think, most of its exposure to oil prices for this year. So they had covered their operating losses. Pemex had hedged some of its production. So they were giving away money on the table when they were already desperate. So economically, this was a pretty bitter pill for Mexico. 400,000 is a lot when they barely got to, sort of 1.7 in March. Politically, I think it was also hard for the president for a number of reasons. His popularity is now dropping after being really the Teflon president for the first few years of his presidency, and a lot of that has to do with his mismanagement of the COVID crisis. So he also ran on nationalism. He ran on making Pemex great again, and on increasing Mexican production, and it's all failing. It's failing in part because he's kind of forsworn foreign investment, because Pemex is spending more money than it's taking in, and because production is not increasing, it's decreasing. So I think that was hard for him. I think the third reason is it was just an incredibly amateurish job, on the part of the energy minister, who is kind of new at this. And sorry to be harsh, but they should have had they were asked to do something which was not different than what Nigeria or Angola was asked to do relative to their own production. So the number wasn't disproportionately large, and the idea that they would be exceptional and get excused when nobody else would is kind of silly. And you don't walk out for a few hours. So people say this is a short-term victory for Mexico because they got away with 100,000 barrels, but I think it's a pretty Pyrrhic victory. In 1998, Mexico led the production cuts with Saudi Arabia and Venezuela. They were a world leader in recovering the price, and then when prices rose, they were a world leader in bringing it back. Now they're really the outlier and to some extent the outcast. Remember, AMLO was going to join OPEC. I think he's probably not invited, right now. And he was going to be totally independent, and yet he needs the American president to bail him out diplomatically, from a deal because he's walked away from it. So these are not big wins for Mexico.
David, thanks. There's a follow-on question from Brian Kelly. What do you think is the quid pro quo for the U.S. taking this perceived hit for AMLO? What went on in those conversations?
I don't know that there really is a quid pro quo for this. For one, President Trump needed this deal to happen more than Lopez Obrador. So, fixing the Mexican problem so he could get the deal was probably quid pro quo enough. But if there was a trade, there's lots on the potential list. Certainly on migration, Mexico wants to make a payment towards the wall. I'm sure the president would be happy to take that as a victory. I don't think that's actually gonna happen. But there's issues on migration. There are issues on trade. I think this is one that the president is just going to pocket for when he needs it, and maybe it's not criticizing him during the campaign.
Got it. Thank you. Okay, turning to RJ now. RJ, as our resident Canadian, I want to ask you about the role that Canada played in this. At one point, there was discussion when there was talks of putting tariffs on Saudi Arabian barrels. That it would be a U.S.-Canada partnership. Then pretty quickly that changed, and Canada was interested in supporting the OPEC Plus deal, was involved in the G20 conversations. What changed? What is the motivation for Canada and some of the other big producing countries that aren't necessarily involved in OPEC Plus itself?
Yeah, I'll step back a little bit on Canada and say that I think the Canadians, along with pretty much every other country we're discussing here, we're talking a lot about the geopolitics and the diplomatic deal making, but let's not forget that there was really a tsunami of crude oil in the market and the lack of buyers and a complete imminent shutdown of global storage capacity in the next 6 to 8 weeks that really motivated everybody. And certainly that's true for Canada as well. And I think that on the Canadian side, the key goal was really to stay very closely aligned with the US. There was some talk here about tariffs. Would those tariffs just be against OPEC? Would they be against all imports, including Canada? That would be a risk they wouldn't want to see. So I think that when Trump pivoted towards an OPEC plus or G20 deal, it made a lot of sense for Canada to go along. Canada, as you know, is a higher cost producer. They've already been struggling with a weaker differential over the last few years due to lack of pipeline capacity. So the storage problems and refinery slowdown and economic slowdown in the U.S. Hits Canada probably just as hard as anybody. So a lot of motivation to get some kind of deal here.
I've got a couple of questions that I think tie into your broader point that this was a deal that everybody sort of needed because of the impending crisis, and it forced a number of policy shifts that you might not have seen had there not been the crisis. Whether the U.S. is ostensibly supporting OPEC Plus, I think Halima described President Trump as the unofficial president of OPEC right now, of OPEC Plus. Tom Cunningham, our friend, asks, it seems until last Friday that a reconstitution of OPEC Plus partnership was not in the U.S. interest. And I want to follow up and say potentially not in other countries' interest as well. How has that changed?
Well, I think from my end, I think we're thinking with the oil market with sort of 4 blocks going forward. And I think Halima has written about this and appreciate this as well. I think you have a North American block. You have your core OPEC countries, especially the GCC countries. Then you have Russia as a standalone. Then you have everybody else. So sometimes disparaging referred to as the fragile and failed states. And I think a lot of those countries are really going to be bypassed in this new order, right? That the North African countries, West Africa, a lot of Latin American producers, when it comes to the big mega oil diplomacy, whether we call it OPEC plus, whether it's G20, it may be that the new normal is some kind of U.S. role influencing Saudi and Russia on oil market coordination going forward, especially in the medium term. If you think that our view at Eurasia Group that the oil price recovery will probably be about 3 years, lagging the larger economic recovery because of the type of inventory build we're likely to have and the continued downward pressure in things like gasoline and jet fuel. So this may be the new normal, and a lot of those countries that have been part of OPEC Plus and core OPEC in the past will not be given much of a seat at the table going forward.
So what will the U.S. want if it is playing this role in OPEC plus, or whatever we end up calling it? What will the U.S. goals be?
Well, I think it obviously will vary a lot depending on who the president is. I think if Biden wins, the G20 will go back to at least be pushed much more towards a climate focus that it had been on the last 3 or 4 years. But if it's Trump, I think it'll be interesting to see if they can continue to balance the U.S. new role as both the largest producer and one of the largest consumers, which is unique. And, it's something I think we're all trying to figure out what it means going forward here as well.
David, and then I think Halima probably wants to jump in as well. David, you're on mute. There you go.
Sorry, thanks. I just have to say the cognitive dissonance of this moment is just incredibly powerful. This looks a whole lot more like energy submission than energy dominance. I mean, here you have the president of the United States basically pleading with OPEC to act like a cartel and get together and constrain production and ask other countries to do it. He's kind of succumbing to pressure or dealing with pressure from Mexico, to please, help save the deal because we're not going to do it. All in the interest of raising oil prices. So this is kind of a new vulnerability. It's hard to believe it's going to be the new normal because the U.S. didn't actually join OPEC. We're not really using the federal powers which the president had to curtail production. But we are now in a position of, sort of pleading for OPEC as opposed to, opposing OPEC's idea as a cartel. And it's just a very dissonant moment.
Can you see Trump going back to his previous ways of if he's elected and the price goes back up, to tweeting that the price is too high?
Absolutely, because I think consistency is not a sort of a mandate for the president's political strategy. But so I think that's entirely possible. But I think it also needs to be said that a lot of this deal is making a virtue out of a necessity. Storage was filling up. There weren't buyers for this production. It was going to fall off. So instead of the slow bleed of waiting till June, while everybody's equity prices declined, they made a rational step to try and curtail production now. But in the second half of the year, either if demand picks up or just as restructuring takes place in the shale patch, the market will take over. The market is going to clear, here, and it's going to, to require these countries to curtail production. So I don't think this is a lasting moment in that sense, because we were just dealing with a short-term period before the market imposed this discipline, regardless of the political desires of all the parties. And I think come June, July, August, that's back to where we're going to be.
Got it. Halima.
I think what's really interesting is I think it showed us the world of NOPEC. You think about the last 3 years, you've had President Trump highly critical of the producer organization, many members of Congress, led by Senator Grassley, very critical of OPEC, calling it a cartel, wanting it subject to storm and antitrust legislation. And I think this past month, we've seen the world of, not having that sort of market manager. What happens when you don't have the central bank report without the regulator? And I think we now see the kind of ties that bind, frankly, shale to OPEC. Every time we have an OPEC meeting, we have U.S. E&P producers waiting for the outcome. So at a minimum, it has shown a mutual dependence between the U.S. energy sector and OPEC. And I think about, the Global Energy Forum in Abu Dhabi in January. At that moment, you had President Trump out there saying, we do not need Middle Eastern oil. And many people from the region were really taken aback by that. This has really shown that we do need the Middle East in a way that we may have believed we did not until this point.
RJ has an intervention.
Yeah, I would just quickly add to that. I think I agree with that view that this is really about mutual dependence rather than domination or submission on either side. That each party in the sort of Saudi-Russia-U.S. relationship is bringing something different to the table. But I think that really is good. The new normal to me is that there's going to be some interplay there, much more so than the traditional OPEC dynamics in terms of intervening when the market circumstances require. Which I think I agree with the speakers here that we will be back to this moment again here, probably even 2 months down the road. Will we be extending these cuts? Will we be deepening them? Will the U.S. have to go to more mandatory curtailments, or will Canada have to? I think that's all fair game for discussion, but I think it'll be resolved more in this OPEC plus group among the U.S., Russia, Saudi, because of this mutual dependence that Liam was talking about.
Got it. Let's talk about the U.S. for a second and the U.S. market. What did the U.S. actually get out of this? And this is a question coming from Ethan Zindler from Bloomberg New Energy Finance. So what did the U.S. actually get out of the deal? WTI is still at $23, way below what shale producers need to break even. He understands why Trump wants to take a victory lap, but what is the actual victory here? If you want to be, maintaining the U.S. as the world's largest oil producer, and he asks everybody who wants to jump in first. I'm looking at RJ, who went.
Yeah, I think the U.S. got quite a bit here. I think that I think we would have been in a $10 price environment, not a $25 price environment. And I think that would have shifted U.S. shale from hibernation to liquidation very quickly. I think in our models, we still have liquidation as a possibility, but I think that the timing of that is pushed out a couple months by these production cuts. And the difference between hibernation and liquidation would be basically in the hibernation scenario, it's your bottom quartile producers that are in trouble. But in a liquidation scenario, it could go much deeper, and you could end up with the U.S. down 3 or 4 million barrels a day, or even 5 million barrels a day versus probably 2 million.
Got it. So what's going to happen over the next couple of months with shale producers? How does this impact U.S. production? Who's going to survive and who isn't? And what are the potential politics that would need to be resolved if we're going to do a bailout, for instance, to try to keep the U.S. going? It's a lot of questions, and I know David wants to talk a little bit about shale. So David first. You're on mute again. Still on mute.
There we go. I think we caught a breather for shale, but what's going to happen over the next couple of months is a lot of these companies which could not survive at $20 and $30 oil caught a little bit of a breather, but I think they're really headed for restructuring. We saw this for Chesapeake and Whiting and for others. So I think you're destined for restructuring regardless of this deal. I don't think you're going to see a bailout specifically for shale. I think you've got some unemployment to cover the shale workers, but I don't think you have the SPR either purchase or the storage option, which will provide some relief. But this was coming before the price crash. The reality was you had a lot of companies which were not extremely profitable, even at those pre-COVID-19 prices, and you were looking at consolidation. And I think you saw in the run-up to this how the IOCs were not looking for a bailout, didn't want the president to do import tariffs, didn't want quotas, and are opposing the Texas Railroad Commission and other state regulatory agencies from taking these mandatory cutbacks. They're like, let the market work this out. The most efficient producers will survive. That's the American way. This time should not be different. So you're seeing that play out in the shale patch, and I think that's largely the way that it's going to go. I don't think you're going to see a lot of acquisitions because there's no reason for companies to buy the debt of these small independent producers. I think they're just going to buy the leases when they come up if they need them. And shale is really resilient. So I think RJ may be right. There are some companies maybe in the third quartile rather than the bottom quartile, which can cut back on their production and can optimize their wells, and maybe they can restructure in a way that they'll survive. But probably there's going to be a lot of change coming forward.
Got it. So pivoting outside the U.S. for a second, I want to go to Kirsten and talk about what this means, what the general price environment means, but what the deal also means for countries like Iraq, like Libya, where it was pretty bad, and the price isn't getting much better. What do you think these implications are?
Sure. Iraq had already increased production because of their budget problems. So the 23% cut, it's about 1 million barrels per day for them, is going to be tough, especially right now while they're trying to form a new government and their country is a US-Iran battleground. So if we want to wag our fingers at them, we can tell Iraq they wouldn't be in this position if 2 or 3 years ago they'd implemented the World Bank LNG reforms that were recommended. Why didn't they implement these? Because Iran blocked them. Iran was enjoying being able to export LNG to Iraq and charge them 2 to 3 times the market price for it. So Iraq also uses a lot of oil internally, so they'd have to increase production substantially to make some sort of dent in their budget need in terms of what they were bringing in from exports. Maybe, OPEC could perhaps tie production cut requirements to benchmarks in World Bank reform implementation, or the US could tie waivers in Iraq's importations from Iran to such benchmarks. But other than that, the US doesn't really have a lot of leverage. There's not a lot we can do here. It's really between Iraq and OPEC. The most common approach I've seen discussed by US government folks who work on this every day is the implementation of these World Bank LNG reforms. Kind of what do they call for this? Scaled but immediate bidding rounds for contracts that are based on production sharing agreements. That's how the UAE and Qatar have become wealthy. It hasn't empirically been a bad model. What we're running into on the ground is realpolitik, where the Ministry of Energy in Iraq is very resource nationalistic. And they believe that everything in the ground should be Iraqi. But when you don't have any capital to put into your own sector, that becomes a very non-realistic approach. So, if the energy ministry in Iraq would see the wisdom in engaging in a bidding round pretty quickly, then you might be able to convince the US to allow them some waivers if they saw movement on that. I'll stop there on Iraq.
Got it. RJ, I know you follow what these implications are for other countries. Do you think this helps prevent some of the projections we've been seeing about, say, Nigeria really going off really having instability, or do you think that that's still a big risk?
I think it's still a big risk, because I think that the problem that a number of these countries are going to have is not just sort of short-term prices, but the sort of longer-term investment in replacing their declining production and attracting new greenfield investment for oil and gas. I think that, as we all know, the oil and gas sector have been struggling in equity markets over the last 5 or 6 years. I think that post-COVID-19, the available pool of capital for oil and gas can be even smaller. And I think that investors and the boards that they control can be very selective in where they invest. I think the US shale will still be okay. I think the Saudis and Kuwaitis and UAE will still fund their own development for the most part. But after that, for anything that's long cycle and upstream, like, for example, Nigerian deep water, the Brazilian deep water, Mexican deep water, Canadian oil sands, it's going to be very, very difficult. We'll need to see some new capital pools form, probably more government involvement, and then I think capital moving even more towards gas and clean tech.
RJ, there's a follow-on question. Actually, Kirsten wants to jump in, so go to Kirsten, and then I have a follow-on question for RJ.
I was just going to mention, from those of us who watch this from almost purely a national security perspective and rely on wisdom from people like you for the actual energy analysis, we worry exactly about the scenario that Robert just mentioned. Particularly when we watched what's happening in the G20, when we saw the Europeans really try to twist the conversation to one about renewable energies, and the fact that Germany will take the presidency of the G20 next. That becomes an issue for us when we look at what are the available pools for financing of global energy, because it starts to look, especially in a post-COVID environment, like that's really coming down to places like China only.
And that's actually a perfect lead into the question from William Janis. And we'll go, RJ can take this. Kirsten, if you have any thoughts or others, but what is the impact, potential impact on renewable energy if you have pools of capital for hydrocarbons drying up?
Well, I think that certainly the hydrocarbons, higher prices for oil and gas would stimulate even more capital flowing into renewable energy. Less so, I think, in electric power, where the levelized costs have become quite competitive for things like solar and wind. But in the work we're doing at Atlantic Council on transportation, as you know, Randy, I think that a key part of the transformation would have been higher oil prices. So will governments now step in places like the EU, Japan, China, maybe Canada, with green stimulus to try to put some more tailwind into the transformation of the transportation sector? Dollars are going to be scarce given the massive public debts that are being accumulated. But I think that those governments, especially China, will be looking closely at other things they can do to become the Detroit of the 21st century, the electric vehicle leader, as part of the stimulus package post-COVID. And that might be the key factor for getting more clean tech in the transportation sector.
Got it. David, do you have any thoughts on this?
Yes, I wanted to add two thoughts. One is on investment. I would just take a little bit of issue with RG. I certainly agree that it's going to be fierce competition for capital, but the reality is, as the economy comes back, it's going to be a question of what's the risk and what's the return. So I am far less worried about a Brazil, which has large-scale assets and relatively stable terms and good returns. I think they're going to be okay in this. The question for Nigeria, for Angola, for a lot of other countries is, are they going to adapt or die? And so I think there's a potential for those frameworks to adapt in a way that would be attractive, but they'll have to change. On the energy transition, I would just say the other cognitive dissonant moment that I'm having here is that Bernie Sanders' agenda has largely been co-opted by the oil patch. You know, that the idea, even though they weren't used, that you can, I mean, look at the measures that are out there right now. The government spending billions of dollars to purchase energy. Right now we're talking about SPR oil, could be renewables too. The idea that you would stop production on federal lands or freeze production in the Gulf of Mexico. Well, that was raised in order to raise prices, but maybe you would do it to cut emissions. The idea that Texas Railroad Commission would ration production, you could do that based on methane emissions rather than just on, you know, a pro rata cut across the board. But these tools, which were unthinkable 4 months ago, are crazy leftist greeny ideas. This is now raised by the oil patch, and it changes the dynamic. With a new president and a new initiative, I think all these things are now thinkable and they're all on the table. And I think that's going to change the kind of response we're going to see going forward.
Fascinating, fascinating. So following on this a little bit, from Nobu Tanaka.
Randy is freezing just a little bit.
Smart guy here. Have you lost me for a second?
You're good now.
You're back now. Can you start the question again?
I'm back from Nobu Tanaka from Japan, and this ties into a lot of what RJ and David were talking about, and ties into some of the work that RJ is doing at the Atlantic Council. But do you think that 2019 will be a year for global demand, and that we're actually not going to return to the past, and the new normal will have significantly lower demand? And I think a number of you will want to jump in. So, but we'll start with RJ.
Yeah, I think it's that fear of lower demand and a weaker market going forward that will really hurt the Brazils and Canadas and Mexico. So I think that, you know, David and I can have a good debate on this, I'm sure, but I think that, you know, countries like Brazil and Canada weren't exactly in a great position for attracting investment even before COVID-19. And I think that the risk aversion for these long cycle projects, which may not have the kind of security issues that you have in the Nigerias and Iraqs, but still have a lot of other complexity, I think that's going to be even more challenging now. So I think there's such a strong tailwind from the asset management community towards pushing, you know, the post-carbon economy, pushing energy transition, that will feed back into the super majors, and even some of the national oil companies are going to the public markets now, and steer them away from some of these other countries. So Tanaka-san could be right. This could be the beginning of a new normal, but it's probably too soon to say.
David?
Yeah, I guess it's hard to predict demand, but every time we have one of these crashes, you know, 98, 14, things kind of come back in a similar way. You know, the demand for, you know, for return is higher and the tolerance for risk is lower. But I look at a Guyana, you know, or something like that, where you have a large asset and therefore low unit cost for that production. And I think you're still going to see the big companies who are looking at, you know, sort of 20, 30-year demand willing to go into those places, but their tolerance for, you know, for Iraq, you know, for, you know, $2 a barrel for service agreements in Mexico is going to be negligible. So I think that's where there's going to be a real sorting of the herd in terms of who's able to, you know, to survive in this post-COVID and post-OPEC plus world. But until the big companies believe that the future of demand has permanently changed and that all of the curves that we were looking at for 20 and 30-year outlooks are no longer valid, they are still going to be investing in these large-scale, low unit cost fields. And so I think, you know, for Canada, it's harder because of climate and other things. For Brazil, I think they look good. For Mexico, not so good. Mozambique, probably be okay. If people really believe that the future of demand has changed, that air transportation is going to be different, that vehicles are going to be different, that might happen, but we're not seeing that yet.
Got it. Thank you. I want to ask one more question about U.S. shale that came in that I should have asked earlier and I missed, and it is from, pulling up in my chat here, from Karen Young. What do we know about resilience for shale production in terms of how long shale wells can be turned off and then resume production? Is it a myth that shale is easier to resume than older wells in the Gulf, for example? More concretely, does the production cut agreement give a lifeline to shale as Trump hopes, or do we see shut-ins and failure across the U.S. industry in the next year? So there's a lot there, but I think getting at that question of U.S. shale wells being turned off is a good one. So David or RJ want to take that?
Sure. RJ, you want to go first?
Sure.
David,
RJ, sure. As with most things with shale, it's hard to generalize about the whole complex. There will certainly be some older, less productive wells that were drilled, 3 or 4 years ago that are, could be shut down pretty easily. The sort of newer, more prolific wells, it's not a question of engineering. It's more a question of the companies wanting to keep those wells going as much as they can to capture that high level of initial production. But there will be a lot of variation within the various shale basins of what makes sense from a cash cost basis, what is easy to shut in versus hard to shut in from a reservoir perspective. But the one thing that everyone will struggle with is storage, right? So to some degree, it doesn't matter whether your wells are efficient or not, or whether they cover cash costs. If there's no storage, then you have to shut it in and then hope for the best when it comes to a restart.
Yeah, I just add that the U.S. shale patch is the great underground storage oil field of the universe, and so it's a geologic fact. We know what's there, and it is able to come back in a year if demand were to pick up. So I think that's good news for the long-term life of U.S. shale. But in the short term, I don't think this is a lifeline. I think this was just sort of a little bit of a little bit of an extension. But the president is counting on and promised to some extent by tendering the short-term energy outlook from the Energy Information Administration. He promised 2 million barrels a day cut by the end of the year, and that's what EIA is projecting. So I don't think anything that has happened is going to change that decline unless we see some dramatic pickup in demand. So not a lifeline, but it is resilient. And when demand picks up, it will be the first province back because it is short cycle. And I would not underestimate the productivity and resilience and creativity of shale producers, large and small, to further optimize their production and spend less money, looking for fracks and producing more oil. But it's going way down before it comes back up.
Got it. Thank you. David, you said something that makes me want to sort of widen the aperture a bit and go back to the deal and of getting to whatever that 20 million barrel a day number that Donald Trump tweeted out this morning. And you mentioned that, of course, the U.S. said that Donald Trump proffered the EIA study to 2 million barrels a day decline. But Halima, how do you get from this 9.7 that was announced by OPEC Plus yesterday to 20? What do we have to do, and how to actually get there, and how much of that is real versus how much is that creative math?
I mean, is there a lot of creative math to get to 20? Of course. I mean, in terms of OPEC, you have to take the absolute highest potential benchmark that these countries would say they were producing. So instead of using an October 2018 number, which is the official benchmark, you use what they were saying they were going to do in April. Saudi talked about doing 12.3. You have to go 12.385 to get Saudi as close to 4 as possible. Same thing with the UAE and Kuwait. So again, taking the highest possible number in order to build out that OPEC contribution. But in terms of the rest of the non-OPEC producers, it's essentially taking an expansive view of what the market-driven declines would be. So essentially, if Secretary Burlett goes to the G20 and says 2 to 3 million from the United States, probably put 3 million in there. So you're taking the biggest view possible of market-driven declines. We haven't heard what Norway's contribution is. Again, I think they would be looking around the globe to see what will the market-driven declines, and then you kick in Venezuela sanctions, Libya's continued implosion, and that's how you get to that sort of really big 20 million headline number. But the cuts that really matter, I would very much focus on. The Saudi cut is a real cut. The Emirati and Kuwaiti cuts will be real cuts. We have to see what Russia does. But again, turning off the taps is so important, because if they had kept this gusher of oil going that nobody wanted, you would be talking about a single digit, and you would be talking about the first available off-ramp being that June OPEC meeting.
Got it. Anders wants to jump in there.
Yeah, I see from the Russian discussion that they are discussing that Norway is likely to cut 1 million barrels, Canada 1 million, Brazil 1 million, and the US 2 or 3 million. That is what is outside of the OPEC plus, that is OPEC plus Russia. And that gets us to 6 million barrels. And then I presume that President Trump use some creative math.
So we have this creative math, which, and some of it actually feels more like kabuki theater than creative math. Kirsten, do you have any sense of how that was appreciated in Saudi, in Riyadh, when the US was coming with some of these ideas that don't necessarily add up, but definitely help make the case, make a stronger narrative for cuts? Do you have any sense of that conversation? And you're on mute. There you go.
A sense of how Saudi received the arguments from the US about the cuts?
Yeah, exactly. Yeah.
Well, Saudi sees straight through any arguments we present. And, so their read on it is almost better than our arguments. And what they're reading right now is that the president's in a pretty good position to put pressure on them because, frankly, this sounds awful, but it's the silver lining of COVID because his base now not pushing for low oil prices frees him up to lend very vocal support to the shale sector. Prior to this, he was kind of caught in the middle of that, torn in two directions, had to pretend he was supporting both, but couldn't really weigh in on either side. And therefore you saw that statement about, I'll get involved when I have to. Well, now he can openly get involved because the demand side is not putting pressure on him politically. And the Saudis know that. So when the president comes to them, they don't have that sense of security. He can't act against us right now because he's in an election year. He can. And Congress can act outside of the president. So they understood that, regardless of whatever the arguments might be, the point was that they could wind up getting whiplash by Congress if they didn't play.
Lima wants to jump in on that.
Yeah, I just think it's really important to sort of think what's different now than in the 2014, 2015 price war, where the Saudis essentially were saying, we'll let it be 20, we'll let it be 30, we're never going to cut. His Royal Highness wanted a cut from February. I mean, he was pushing for that emergency OPEC meeting. He had done nothing but ask for a deeper cut from the beginning of the COVID-19 crisis. So I think in some respects, the stars kind of aligned. It wasn't a case that they weren't willing to do it. So once you got Russia there, I think that was so essential. Once you got the Russians there, you got them what they wanted to do, what they wanted to do. I think Mexico, that's where the president really had to get them to show some flexibility, but they basically accomplished 90% of what they were looking to do from the outset.
So do you think that the president could have convinced them of accomplishing this if they didn't want to from the beginning? Do you think he had that much leverage over the Saudis?
Well, again, I think it's really important. If the Saudis were basically intent on killing shale, which they weren't. I mean, that's the interesting thing. They really wanted that. If the Saudis were in the Russian position, it would have been, I think, an interesting dynamic. And we don't know how that would have played out. But I think Kristen has all the eyes on all the knowledge on what their leverage would have been. But I think it worked out this way. And the price war could come to a quick conclusion because at the end of the day, what the Saudis wanted from day one was this big cut. And they wanted everybody involved. And so they could be flexible on what does a U.S. cut really look like. It's really important to remember the Saudis are investors in the U.S. shale industry. They have a very good window into the rocks, the geology of it. And so they never said they were trying to price out shale. They think they're making shale more resilient. Again, I think the stars aligned because they wanted that cut from the beginning.
Kirsten.
And Randy, I think another thing to consider here is kind of, we all look at this from a very kind of US-centric point of view, but really Russia and Saudi are deciding their power balance for the next 40 years right now. And the US is kind of a sideshow. They've been at power balance dance in Syria with regard to Iranian arms on several planes, and they're going to both be in power, these leaders, if Putin has his way, for several generations where we kind of, we flip our decision makers and we're kind of expendable in some ways. And they're trying to work out how that will play out between the two of them. And Saudi really needed to show that it has some weight in that game. they're looking also right now, the counter to that is to court Russia's friendship against the odds that a Democrat wins in November here in the US. Because if Saudi waits until they're facing a hostile Democratic administration to try to court Russian friendship, Russia will raise the price of that friendship. So we should expect that Saudi to make some new deals in other sectors with Russia right now to make amends for having to do this deal that robs Russia of the pleasure of tanking the US shale industry. And we're seeing them talk about things like civilian nuclear energy, which is also a concern for us, but that conversation is happening. They're talking about pathways to a virus vaccine. Saudi buys a ton of wheat from Russia right now. They're coordinating on projection into Africa based on Russia's previous experience with Ebola. And I think that's important, particularly in the context of what David was saying about how all of the potential survivors from this wind up being places like Guyana and Mozambique.
So do you think one of the silver linings from a U.S. perspective on the March OPEC Plus meeting that fell apart was that it put a wedge between Saudi and Russia? Do you think that has collapsed and that we'll see Saudi and Russia even closer and together than they were before? And Kirsten, and I think Halima wants to answer that as well.
I think there is a wedge, but I think Russia also thinks that there's a wedge between the U.S. and Saudi based on this negotiation. So, and the wedge won't last. As I mentioned, they are both long-term lookers, and MBS and Putin are both saying, I don't know what I'm going to get in November, but I know what I'm getting in Moscow, and I know what I'm getting in Riyadh. So I need to think about what I want my dynamic with that capital to be, and what I want out of that relationship. So, again, we're the sideshow in this, as much as that is difficult for the U.S. to swallow.
Halima, and then Anders.
Yeah, I think it's the perfect segue to Anders, because I think one of the really important points that Kristen just made when she talked about the other deals that are going to be signed between the Russians and the Saudis. And it's important to remember, if Igor Sechin was kind of the villain of the story, the one who drove the price war, the one who maintained the back channel communications between the Russians and Saudis was Kirill Dmitriev, the head of the Russian Direct Investment Fund. So I think it's going to be very interesting to see what deliverables Kirill can basically take to President Putin, because he was the one who consistently kept lines of communication open with the Saudis throughout the crisis.
Got it. Anders.
Yeah, no, my view is very much the same, that Putin and Minister of Energy Alexander Novak, they have now really sucked up to the Saudis. Putin had phone calls both to King Salman and to MBS on the 10th of April. Putin has worked the phones, so not only with Trump, but also with the Saudis and others. So he has put himself in much more essential position, and he has been working on this for a week. So I think that he has greatly improved the relationship with Saudi Arabia. Presumably this means that he has somewhat dropped Iran, which a month ago seemed to be closer to Russia than Saudi Arabia. So this is another aspect to keep in mind.
Okay, thank you, Anders. We have just under 2 minutes left, 1 minute now. So I'll do a quick round robin about what you are looking for over the next week, month, and through the end of 2020 in the oil market. And we have a range of questions very specifically about what we'll be looking for tomorrow with the Texas Railroad Commission. So if those of you who know about the Texas Railroad Commission would jump on that, that would be fantastic. So we will start with Kirsten. What are you looking forward? What are you looking for the next week, month, through the end of the year?
5-second nutshell, I'm going to be watching for Russia to double down on efforts to secure their sway over oil decisions made in Libya and across Africa.
Got it. RJ.
I'll watch for the Texas Railroad Commission. And my hot take is that I think they may surprise people. Maybe not tomorrow, but I think that this is such a mess in some of these state markets that these states do have regulatory powers to intervene. They may have to do so.
David.
I'm looking for pressure on the Texas Railroad Commission and in North Dakota and a number of other states to make a contribution. It's a 60-day look-in. And come June, I think if there's no response from the U.S. shale patch to make a contribution, then it's going to be a little bit of a harder conversation in June than it was this time.
Anders.
Well, of course, what we all look at every day is where will the oil price be